For a closer look at this, we have Michelle Schneider. She's a chief strategist at Market Gauge. Good to have you on again, Michelle. So Jerome Powell, in his semi-annual testimony to Congress, indicating that the Fed is in no hurry to lower those interest rates. This is consistent with his messaging for a while now, but is there anything else that stood out for you or anything that you think investors should be paying attention to?
Well, a couple of things. He actually said it before and he repeated it today. And that is that the labor market weakens significantly. Of course, he will change his tone. So that tells me that he may be less concerned about rising inflation and more concerned about a real sputter to the U.S. economy. And I think that definitely merits paying attention to. And one of the things we're watching very carefully as a result is the reaction, not just of the short-term interest rates, but of the 20-plus year long bonds, which right now have seemingly bottomed out. And if they start to pick up from there or the long bonds actually yields drop, that might be more of a price indication that there is concern. And of course, that will have its own impact on the markets.
Yeah, it's interesting because he said that, or rather he told U.S. lawmakers that the jobs market remains sound. I'd like to know that combined with the impact of retaliatory tariffs on the U.S. economy on top of the impact of tariffs themselves, how that all plays into the U.S. economic health picture. I mean, and also what this means for the Fed when it comes to dealing with inflation and how it figures into their policy path.
Well, we might go back to the inflation transitory conversation. I mean, it's possible. But what really strikes me right now in terms of the impact to the labor market in particular is if ideally what Trump wants is to be able to produce more in the United States, there's a couple of things that are going to be headwinds for that. Number one is it takes time to pull a lot of these resources out of the ground. They don't just happen overnight. And it takes manpower. And a lot of the manpower involved are jobs that a lot of Americans don't typically want. And while we're dealing with deportation, that's another potential hit to the labor market. So I think for Powell, that's what he's looking at. And the way we can look at it too is through the consumer. Because just right now, the consumer is starting to lose faith in that inflation will not go out of control because they're already starting to see signs of it in all different types of places. That too, of course, 70% of the GDP will also be another nail in the coffin to the strength of the economy. And we'll see how Powell reacts to that if it happens.
Yeah, and speaking of that, that's going to be a key indicator to watching out for the U.S. CPI data coming in about 14 hours from now. Your expectations on what we could see and how that is likely to move markets?
Well, we've seen last month what happened. They came in better, CPI, PPI, than people expected, and the markets sighed relief. But really, it was such a temporary relief in terms of commodity prices because gold, we know, has just made new all-time highs. We're starting to see a lot of the food commodities go up. Coffee just made new all-time highs. We're seeing steel and aluminum, to say it like an American, also prices going up, copper prices going up. So I don't think the CPI, unless, first of all, I don't think people will really believe it because it excludes energy and food, number one. And number two is it's a lagging indicator. It's not a leading indicator. And so really, I think what all eyes will be looking on is whether or not Trump is being excessive in his threats of tariffs as a negotiating point, or whether this really does come to pass. And then the deglobalization in and of itself is inflationary.
So that's pretty interesting because overnight, markets were not surprised, or rather it seemed they barely had any reaction to it. Very muted movements that coming on the back of what Jerome Powell said about the interest rates, and also as we're hearing, threats from the EU on retaliatory tariffs. And so what do you make of this reaction, or sort of lack of reaction from the markets?
I think the market doesn't really know what to do. When I say the market, obviously the people who are trading the market, we have retail speculators who are looking to buy every dip because that's what they've been doing in their anticipation that things will resolve. And then we have institutional sellers that are doing a tremendous amount of selling into this rally. Hence, we're in this stuck trading range right now. And what is going up, interestingly enough, are, yes, of course, some of the growth stocks, but really basically basic materials. They have outperformed everything right now. So what is the market telling you? It may be muted in terms of equities, but in terms of commodities, I think the potential is there if that continues for this sort of super cycle to begin. And if that's the case, we'll have a bigger reaction to the markets, most likely more of selling coming in.
Yeah, and on top of that, just follow up on that, talking about the super cycle in commodities, gold surging some 10% year to date. Those tariff threats helping to drive up demand. Do you think there is going to be more upside to the precious metal, and how should investors be viewing this?
Well, gold is reacting to pretty much everything. I mean, sort of pick your poison, right? Tariffs, deglobalization, high debt, government spending, geopolitical stress, the Middle East, rising oil prices now. So it is essentially almost a barometer of all the ills that are affecting the market, the economy potentially, and globally as well. So unless any of those things really resolve in such a significant way, I don't see any reason why gold prices will go down. If anything, they still look relatively cheap in comparison to where they could be in, say, 6 months if they take out 3,000 and easily could go to 3,400.
All right, Michelle, I really appreciate your time. Michelle Schneider, their chief strategist at Market Gauge.